Michael Burry has basically been missing in action for almost 3 years. He's refused to comment on the ridiculous AI speculation and bubble and the insane economic data that we've been seeing over the last couple of years. That was until last week, when he came back out of the woodwork and launched a huge attack on the AI bubble, on the hype and the speculation altogether. But he also basically accused Nvidia, Palantir, and a few other of these big tech companies of fraud. And at the same time, he released filings stating that he's betting $1 billion against AI, showing just how clear he is in his conviction that this is an AI bubble. So in this video, I'll explain exactly what is going on with Burry, I'll break down exactly what he has said, and I'll try to decipher exactly why he thinks this. So let's start off with Michael Burry's Twitter. It is obviously called Cassandra and has been for a long time. This is a callback to the ancient Greek mythology and this woman who could predict the future, but she was cursed to never be believed for her predictions. And Burry is a pretty good analog to that story. So that's why on these tweets you're going to see that they're coming from someone called Cassandra, but this is actually Michael Burry. As for what he's actually said, this was the first thing that came out. Sometimes we see bubbles, sometimes there's something to do about it, sometimes the only winning move is not to play, with a picture of his character from The Big Short. Pretty self-explanatory here. It's actually quite easy to spot a bubble, but timing its crash so that you make money betting against it is really pretty difficult. And so sometimes, and for some investors, it's better off just to ignore that whole mess together. Not what Burry is doing, he's doing the opposite. But it seems that he might be encouraging others to just maybe sit this one out and not take out any huge risks betting against AI. Then he posted a tweet with 3 separate graphics, and the quote being, "These aren't the charts you're looking for, you can go about your business." The first of those charts is this infamous circular deal graphic that came out from Bloomberg about a month ago, showing how money is being passed between various different AI companies in the form of revenue and investment and loans and all sorts of other things, and how this is basically disguising the true revenues, the true profits and underlying fundamentals of these businesses, which is inflating their values. And this has been covered many times, but Burry is once again drawing more attention to it. The next graphic he showed is this one here, titled Cloud Segment Year-over-Year Growth, Average Growth Rates Across 2 Key Periods, covering Amazon, Alphabet, and Microsoft. And you can see the black bar here is the average year-over-year growth rate for 2018 through 2022, and the red bars is from 2023 to 2025. Now, the common wisdom and expectation would be that these AI-inflated stocks, they're investing more into cloud computing right now than they were before AI became this hyped up idea, but that doesn't seem to be the case. With all 3 of these big tech companies increasing their investment into this sector more rapidly from 2018 to 2022 than from 2023 to 2025 when AI came into force and this hype bubble started. It's also important to note that this is the year-over-year growth, so the outright investment numbers are still getting bigger and greater for all of these companies than they ever were in 2018, say, for example, but the percentage increase is lower. And also, cloud computing, I'm assuming here, includes storage and computing power, whereas most AI infrastructure is usually just computing power, so it's a little bit different. But this here suggests that, in my opinion, Amazon, Google, and Microsoft, they're actually not anticipating AI being as revolutionary as most people think. Their growth is a little bit more held back and reserved, as opposed to the other big AI players like OpenAI or Oracle. And then the final graphic that Burry posted is this one here. Basically a graph showing how much US tech companies and another metric for telecom companies are spending on capital investment. And this shows us on a rolling basis, month over month, going back about 30 years, back before the dot-com bubble. Obviously, we see there is a massive spike of investment around the dot-com bubble, and over the last year or so, we've seen another massive spike of investment. And then the other really important thing is that when we see these spikes of investments at their absolute peak, that is when the recessions actually start. That's what these gray bars here are. Recessions from the dot-com boom, recessions from the housing boom. And if we're interpreting Burry correctly, he's essentially stating that there's going to be a recession coming at the top of this boom here as well. Now, those 3 graphs that he showed didn't come with much context, and he didn't give us much of an idea into what his state of mind was surrounding those graphs. But where he did give us more context was with this tweet here. Understating depreciation by extending useful life of assets artificially boosts earnings, one of the more common frauds of the modern era. Massively ramping capital expenditure through purchase of Nvidia chips or servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Yet, this is exactly what all the hyperscalers have done. By my estimates, they will understate depreciation by $176 billion by 2026 to 2028. By 2028, Oracle will overstate its earnings by 26.9%, Meta will overstate their earnings by 20.8%, and so on. But it gets worse. More detail coming on November the 25th, so stay tuned. And then he showed us this graph here, which is exactly what it sounds like. This is each of the big main companies which are investing so heavily into these AI chips, and then how long they expect their brand new chip farms to last before they are basically useless after being created. So in 2020, when Meta built a chip farm, they expected it to be depreciated over the course of 3 years, as in after those 3 years are done, the computer chips are now completely worthless. That was the same for Google and Microsoft. Amazon thought it would take 4 years and Oracle thought it would take 5. And as we go through the years, all the way up to 2025, we see that all of these companies have been extending the life of their AI chip farms. So Meta have gone from estimating their chips to last from 3 years to 5.5 years. Google from 3 years to 6 years, Oracle from 5 to 6, Microsoft 3 to 6, and Amazon 4 to 5 as well. Basically, in 2020, when a company built one of these massive chip farms, they estimated it would be useless and need replacing within 3 to 4 years. Now, in 2025, they think that they're going to last 5.5 to 6 years instead, which is almost double the life expectancy or half the depreciation. Now, has technology been growing slower than it was 5 years ago? Well, no. Chip technology in particular has been exploding in efficiency, so the life expectancy of these chips should really be getting shorter, not longer. But Burry is making the accusation that this is done on purpose to manipulate the earnings reports and to boost the valuations of these AI companies. Now, say one of these companies just bought a load of chips or built a brand new chip farm and they spent $100 billion on these chips. Well, that's $100 billion worth of assets on their books that are slowly going to be depreciated year after year. And right now in 2025, that would take 6 years for those chips to fully depreciate, which means depreciation of about $16 billion a year. That means that there is a $16 billion per year loss according to your earnings, just from owning these chips and allowing them to depreciate. But if the chips actually expire in 3 years, then that would be a $33 billion loss over each year, which means when you're extending the artificial depreciated life of these chips, you are essentially inflating your company's earnings by that differential. In this case of a $100 billion chip farm, they are saving about $16 billion a year on the headline figures of their earnings, even though there isn't an extra $16 billion worth of cash on their books. And within a few years, by 2028, Michael Burry expects the earnings of these big tech companies to be overstated by 20 to 30% purely because of the manipulating they're doing with the depreciation of these chips. If we then extrapolate that out and estimate 20 to 30% in increased valuations from a 20 to 30% increase in earnings for the big Magnificent Seven companies, and we're probably looking at something in the region of $5 to $10 trillion in market cap inflated out of nowhere from a simple accounting trick. Now, these accusations, these tweets from Burry, they hit the news a lot, but they also came in at the same time as we had new 13F filings from Michael Burry's hedge fund. So Burry's hedge fund, Scion Asset Management, disclosed put options with a notional value of $187 million against Nvidia and $912 million against Palantir as of the end of September. The filing didn't specify the strike prices or the expiration dates of the contracts, and it's unclear whether Burry is so far profiting from the stock changes that these companies have been seeing, in particular over the last week or so. Now, the simple nature of a 13F report means that we don't know much about the put or call options that are listed on them. The reported number here, 187 million and 912 million, that's the notional value of the shares that theoretically could be impacted by the put options. So the options have the ability to affect that amount in valuation, but we don't know how long those options are going to last, or at what price point they become profitable, or how much profit or loss they will drive depending on the changing share prices of these companies, or even how much money Burry paid for these options. We just don't have any information on this. All we know is that Burry has almost certainly opened short positions against these companies to the tune of tens of millions of dollars. Now, Alex Karp, the CEO of Palantir, saw this news and he got very, very annoyed. He saw Burry was shorting him, so he fired back in an interview, getting pretty defensive and actually quite angry, I would go so far as to say, about these doubts against his company. On Tuesday morning last week, Karp took aim at Burry on CNBC. Quote, "As far as I can tell, the two companies he's shorting are the ones making all the money, which is super weird. Like the idea that chips and ontology is what you want to short is crazy." Ontology, the study of the nature of existence, is the name of a core feature of Foundry, Palantir's primary enterprise platform for commercial customers. Karp said it was super triggering when short sellers pick on Palantir, as it's doing noble work by enriching retail investors and supporting military personnel, but their efforts drive him and his team to work harder and make the short sellers poorer. The boss of the AI-powered data analysis and integration company suggested that Burry may even have lost money betting against Palantir and had gone public with his short wager to push down its stock and recoup some of his losses. Now this seemed, in my opinion at least, very similar to what we saw with Sam Altman recently too, who is just at this point refusing to defend his company OpenAI, instead being and acting a little bit more like a cult leader, trying to shame people into not criticizing him and OpenAI, instead of maybe just explaining why someone might be wrong when they come with a criticism. Now, Michael Burry then attacked back, basically just stating it's a little bit ironic that this supposed data company, which is supposed to know everything there is to know, didn't expect this 13F report to come out of Burry's hedge fund. Now, in my opinion, it is clear from all of this that Burry is not a fan of this AI bubble, and he certainly thinks it is a bubble, and that this isn't just created by investor sentiment and hype, but basically by manipulated numbers from these big AI tech companies, and these circular deals and the changing the depreciation of these AI chips. This isn't technically fraud, it all follows GAAP rules and it isn't illegal, but guess what? Mark-to-market accounting wasn't illegal with Enron in the past either, yet it still led to a bubble and a massive fraud. Now, I just want to make a quick point here that we aren't just talking about America here. Yes, the AI bubble is mostly seconded to the United States, but it's an existential threat for the global economy, not just the US, just like we've seen with every other major bubble or recession in recent decades. And the reason for this is because the entire global financial system is so ridiculously over-collateralized and interconnected that even the slightest problem in the American economy can bring the entire house of cards down all over the world, which means you personally are at risk, even if you're in the United States or Canada or an ocean away, like in the EU or UK like me or Australia, you are at risk from this. And I think it's so important that we're able to recognize that and to protect ourselves against what's coming, because it is going to be bad. And I want to help you prepare for these problems. So I've gone ahead and I've put together a free live class that I'm going to be running, teaching you how to build a $3,000 a month online side hustle from scratch today. It's 100% free. I've spent the last few weeks putting this class together and improving it from the last time I ran it, spending literally dozens of hours upon it. And in this class, I'll show absolutely anyone how they can use this new system that my team and I have built to build an online income up to $3,000 a month guaranteed. Now, there are limited spaces available for the free class, only 100 spaces. The last time we ran one of these, those spaces filled out on the first day we announced it. So click that link down below in the description to save your space and to even see what time the free class is actually happening on your time zone. Again, it's free. I'll show you everything you need to build an online passive income without needing any prior experience, so that you can protect yourself from an AI crisis like this, and we'll even have some fun on the free class as we do it as well. Now back to the video, and it's not just Michael Burry from The Big Short that's worried. There's another famous billionaire investor called Steve Eisman, who also had a character actually in The Big Short. He also got very rich betting against the housing market, and he's also pretty worried right now about the American economy and the disguise of AI making it basically look a little bit better than it is, which, if that's the case, is a major problem, because the AI itself is in a bubble, so US GDP numbers look better than they are because the AI numbers look better than they are. So it's this whole incestuous self-fulfilling prophecy. Now, what did Steve Eisman have to say? Well, while GDP growth may indicate a robust economy, by removing AI expenditures from the picture, you instead see stagnation. US GDP in 2024 was $29.18 trillion, estimated to grow by 1.8% in 2025. That 1.8% growth is worth about $530 billion. But if you were to factor in the AI infrastructure spending by the Mag 7 companies like Google, Amazon, and Microsoft, it would total about $400 billion. By Eisman's calculations, meaning if you were to subtract that sum from the projected growth of US GDP, it would amount to very little. The US economy, quote, is not even growing really 50 basis points outside of AI, so clearly there have to be pockets of weakness. We've also been hearing more recently from Bill Gates. The billionaire philanthropist does think the current bubble is akin to the dot-com bubble of the late 90s and early noughties, when several internet-based companies turned out to be overvalued, resulting in a significant crash. In the end, something very profound happened. The world was very different. Some companies succeeded, but a lot of the companies were kind of Me Too, fell behind burning capital companies. Absolutely, there are a ton of these investments that will be dead ends. Gates also said that AI had been the biggest technical thing ever in my lifetime. The value is extremely high, just like creating the internet ended up being in net very valuable, but you have a frenzy. And some of these companies will be glad they spent all this money. Some of them, they'll commit to data centers whose electricity is too expensive. And of course, it doesn't stop there either, with even JP Morgan jumping on the bandwagon. They have just released a new report which asks some very hard questions for the AI hype crowd. A JP Morgan report suggests that the AI industry needs to make $650 billion in annual revenue to deliver a 10% return on investments that companies are expected to make through 2030. The report equates this to an extra monthly recurring payment of $35 from every single iPhone user in the world, or $180 from every Netflix subscriber per month. Although this may sound attainable, you must consider that there are about 1.5 billion active iPhone users across the globe and more than 300 million paid Netflix subscribers. Although the estimated amount will still be divided between individual corporate and government users, that is still a massive number of paying subscribers, especially as many consumers aren't yet convinced of the utility of AI. The report suggests that AI growth won't be constant and that it might experience the same issue that plagued the telecom industry when it first started building fiber infrastructure. The path from here to there will not just be up and to the right. Our biggest fear would be a repeat of the telecom and fiber burnout experience, where the revenue curve failed to materialize at a pace that justified continued investment. Although OpenAI has reportedly already achieved a $20 billion annualized revenue run rate, and Anthropic is eyeing $26 billion in revenue by 2026, these are just reports or targets by individual companies and haven't translated into net profits yet. So the problem is that AI needs to make basically $650 billion per year forever within just 5 years from today, according to JP Morgan, and that's equivalent to every single person who's currently paying for a Netflix subscription suddenly paying $180 every month just for AI. Now that's going to require insane improvements for AI. Right now, the best, most popular AI ChatGPT has only managed to get about 5% of its daily users to become actual paying customers, and those paying customers are only spending about $25 per month on average. And so for the sake of explaining just how crazy a $650 billion revenue target is, already there are 800 million people using AI frequently, and only 5% of them actually pay for it, paying about that $25 a month. If suddenly twice as many people pay for AI and they pay 10 times as much, they're only hitting about half as much of the revenue figure that we need AI to see to even get this capital expenditure paid for. Or to put it another way, we need about 100% of all the active users of AI in the world right now to start paying $100 a month, every month, forever, just to make enough to justify the current investment and the current valuations. And even that only gets AI companies a 10% return on their investment, all according to JP Morgan. Now, in general, consumers don't really pay for expensive subscriptions month after month forever outside of debt like a car loan or a house loan. And the only real exception to that is physical locations like country clubs or gym memberships and things like that. And so AI, in my opinion, needs to fundamentally change everything about our societies and become so ridiculously revolutionary that every single person in the US and Europe pay $100 a month, every month, forever. Now, it should be pretty clear at this point that there are a lot of similarities between the dot-com bubble and the previous technological bubbles that we've seen before. It is now impossible to ignore these similarities. And as an example, let's take a look at these two videos here from the CEO of Enron back during their bubble compared to the CEO of OpenAI today.
And none of this would have been possible had you guys not made these huge bets. With all that said, OpenAI's revenues are still a reported $13 billion in 2025. And Sam, on your live stream this week, you talked about this massive commitment to compute, right? 1.4 trillion over the next 4 or 5 years with, big commitments, 500 million to NVIDIA, 300 million to AMD and Oracle, 250 billion to Azure. So I think the single biggest question I've heard all week and hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just enough. People are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself, including myself.
People who talk with a lot of breathless concern about our compute stuff or whatever that would be thrilled to buy shares. So I think we could sell, your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly.
When these fraudsters get called out and caught for their fraud, they get angry. They don't give reasons why they're right or someone else is wrong. They just refuse to engage and they insult people and they try to change the conversation. The reaction we saw with Enron's CEO is the exact same thing going on with OpenAI's CEO right now. Fraud is being exposed and the fraudster is getting angry that someone else dared to expose them. And my final quick point on this whole bubble idea is that this is a technological revolution and a technological bubble at the same time. Now, in the 1800s, when railways were first invented, there was a massive bubble. There was billions and billions in today's money being spent on railways invested, all from borrowed money, hyped up investors, because people could tell that railways were going to change the world forever. They were going to make transporting things and people cheaper than ever before, and that society would never be the same. And they were right. This allowed the Industrial Revolution to really happen, and these investors did change the world with railways. But it was still a bubble, and there was still too much hype and excitement. And as a result, millions of people and businesses went broke building railways anyway because there was just too much supply and the demand just wasn't there. We then saw the exact same thing happen with the internet and the telecom bubbles in the early 2000s, right? The internet is invented, investors get excited and they think it's going to change the world, and so they start pouring billions and billions of dollars, investing it into the infrastructure, like the railways, but for this time, the internet, for this new technology. So they're putting fiber optic cable in the ground and Wi-Fi and cell towers and all sorts of things like that. And the internet was a revolution that literally changed the world forever, but that was still a bubble. And millions of people and businesses still went bankrupt as the bubble burst because too much money was invested into that infrastructure, and the infrastructure was just not able to make enough money to provide a good return on that investment, let alone pay off the debt that was borrowed to create all this infrastructure. And now we compare that to the housing bubble that we saw in 2006 through 8, and there's a distinct difference here because that was purely a bubble based on hype and debt, not on any new technology. It was just houses at the end of the day. There was no massive infrastructure build out along with the bubble. There were no, ridiculous 1,000% increases in house building numbers, and there was no new technology either. So when that bubble popped, the economy wasn't left with anything positive left over. When the railway boom, right, when that popped, at least the railways were built and they were still useful, even if they weren't necessarily profitable at that point. And the same goes for the internet. At least the infrastructure was built and it stayed in the ground after the dot-com bubble burst, and now we use it today. Now we're able to benefit from the infrastructure today, so we get something from those technological bubbles that still helped us all. And some people think that this is sort of a silver lining for the AI bubble today. Right, they're saying at least the AI bubble today is building these huge, ridiculous levels of infrastructure in computing power and chip farms and storage that we'll get to use forever into the future, right? Well, sadly, no, that's wrong, because the infrastructure for computing power, the core of this bubble, doesn't last 200 years like railways do, and it doesn't even last 30 or 50 years like that fiber optic cable or telecom towers do. It lasts 3 years or maybe, absolutely maybe 6 years at a push if you're trying to inflate your company's earnings before the chips are burnt out, overused, and even if they aren't burnt out and overused, they're just outdated and they aren't profitable to use anymore. So the risk with this bubble is that all this investment into this infrastructure, it expires and depreciates before we're able to use it, which gives us an entirely unproductive bubble and a crash and a recession like we saw with the housing market, where there just isn't a silver lining at all. Now, right now, we're sort of in a little bit of a state of limbo with the US government shutdown that's hindered a lot of data releases. So there's a lot of info that's just outdated or outright wrong at the moment, and we haven't got new stuff in yet, so we just don't know what's really going on right now. There's still probably a few weeks left to go until we start getting new data coming out, but it does look like the government shutdown is over, so that is a little silver lining. We're likely to get some new data points to take a look at over the next coming weeks. In my opinion, it seems likely that inflation is still cooling slowly, but it's still going to be higher than is ideal. The jobs data in the US in particular is likely going to continue getting worse, and GDP growth will be decent in headline figures, but still massively distorted by these massive AI capital expenditures. And then my quick final point here, because it always comes up. A lot of people like to say that Michael Burry predicted 100 out of the last 1 recessions or crashes as a critique, but they usually say this a little bit mistakenly. Because if Burry is predicting a recession, say, based on tech overvaluation and the AI hype, but he repeats his accusations on multiple occasions and makes those claims, multiple times throughout a year, he isn't predicting, say, in 10 different recessions or 10 different problems. He's talking about the same problem the entire time, right? The entire basis of the movie The Big Short, which made him famous, is that it took years and years for his predictions to come to fruition, and he was losing money as the markets buried their heads in the sand for years on end as well. And I see this situation as very, very similar to what we saw back then. Tech valuations have been in a crazy situation ever since the COVID boom and all that money printing and stimulus. Then the AI hype sort of added on top of those already high valuations, and now the AI hype has taken over the bubble. And the fact that this bubble has been growing for 4 years, that doesn't mean it's not a bubble, right? The dot-com bubble ran for the best part of a decade. The housing bubble also ran for about a decade before it finally collapsed. And it's easy to forget, but serious investors, people like Michael Burry, and how you should be aiming to invest yourself, is to not make bets on time horizons of weeks or months, but years and decades. And that does seem to be what Burry's doing here. Now, if you want some more help or some more resources when it comes to your finances, take a look at my free online masterclass where I break down and show you how to build an online income without any prior experience. The link to register for that free class is down below in the description, but there are only 100 limited spaces, so make sure to register as soon as possible to save your space. If you want to tell me how right or wrong I am, or to make a video about something in particular, you can tell me in the comments down below. I always try to read every comment, and if you don't want to miss out on my future videos, make sure to subscribe as well. But if you really want to drive change and help me and everyone else, send this video to someone else. Click the share button, send this video to a friend, a coworker, or family member, and help them out as well. The banking system is screaming out for help. The repo market is spiking to a ridiculous degree, the worst that we have seen in years and far worse than we ever saw happen during the global 2008 financial crisis. But 99% of the media, the legacy media organizations out there, they keep ignoring it, trying to bury the story, trying to keep you